There are at least 5 payments the average American over the age of 65 is legally entitled to collect right now that are sitting unclaimed. Not tax refunds from years ago, not lottery winnings, not anything complicated. 5 specific payments, 5 specific programs that exist right now in 2026 that were designed specifically for people your age, and that the overwhelming majority of retirees who qualify for them will never collect a single dollar from because nobody ever told them to ask. And before I go one sentence further, I need to clear up the single biggest mistake people make when they hear something like this, because it is the reason most people click away and leave real money on the table. People assume a video like this is only for one kind of retiree. Either they think it is only for low-income seniors who are struggling, so if they are comfortable, they tune out. Or they think it is some kind of welfare program that has nothing to do with a person who worked hard and built something. Both of those assumptions are wrong. And I want to be completely clear about that before we go any further. This list is for both of you. Whether your only income is a Social Security check or you have a pension, a paid-off house, and a healthy investment account, there is real money on this list with your name on it. For some of these payments, the largest check goes to the lower-income retiree. For others, the largest check goes to the comfortable middle-class retiree who assumed these programs were not designed for people in their situation. I am going to tell you exactly which group each one helps and how, so nobody watching this can walk away saying this is not for me. The reason almost no one collects these payments is not complicated. Every program I'm about to describe requires you to take an action, file a form, make a phone call, submit a request. The money does not arrive automatically. It does not show up in your bank account on the first of the month because you turned 65. It sits in a government program or a state agency or a federal fund, waiting, while the people who qualify for it go on paying bills they were never supposed to pay and missing checks they were always supposed to receive. In the next 20 minutes, I'm going to walk you through all 5, one at a time, in plain English. And then I'm going to add 3 bonus moves at the end for the retiree who has built up some assets, because those last 3 are the ones the financial media never explains to ordinary people, and they can be worth more than everything else combined. Here's the one idea that ties all of this together. Being entitled to a payment and actually receiving it are 2 completely different things. The law does not mail you a check because you qualify. Nobody calls you on your birthday to tell you the program exists. You have to know the rule, you have to claim it. That is the entire reason this video exists. My name is Marcus Steele. I'm an enrolled agent licensed by the federal government to represent taxpayers directly in front of the Internal Revenue Service. I sit across the table from the IRS on behalf of real people, and the single most painful thing I see in 20 years of this work is not people who cheat. It is honest, careful retirees at every income level missing checks they were always entitled to receive year after year, simply because no one ever told them the program existed. That is the most expensive kind of mistake there is. There is no penalty notice. There is no alert. There is just money sitting in a government program that never makes it into your pocket. So let us fix that right now. 5 payments plus 3 bonus moves. Stay to the end because the last one is the one that quietly costs the most people the most money, and it is one of the easiest of all to collect. Let us start with the one that is new, that most retirees have never heard of, and that has a deadline attached to it that makes it urgent. Payment number 1 is the senior bonus deduction, and I need you to really hear this because for millions of seniors, this is the biggest single piece of new money available to them in years. In 2025, Congress passed a new law called the One Big Beautiful Bill Act. Buried inside that law is a brand new deduction specifically for taxpayers who are 65 and older. It is $6,000 per person. If you are married and both of you are 65 or older, it is $12,000. Here is what makes it so powerful. This deduction stacks on top of everything you already get. It sits on top of your regular standard deduction. It sits on top of the extra standard deductions seniors have always been entitled to for being over 65. You do not have to itemize to claim it. You do not give anything up to get it. It simply reduces your taxable income by $6,000. And here is what that means in real money. A single retiree with income under $75,000 qualifies for the full $6,000 deduction. A married couple qualifies for the full $12,000 as long as combined income is under $150,000. The deduction only begins to shrink above those numbers and does not fully disappear until you are above $175,000 as a single filer or $250,000 as a married couple. The only people this truly leaves out are the genuinely wealthy. For the lower income retiree, living primarily on Social Security with a small pension or modest IRA withdrawal, stacking this new deduction on top of everything else very likely pushes your federal income tax all the way to 0. The White House estimates that 88% of Social Security recipients will owe no federal tax on their benefits as a result of this change. That is not a small thing. That is the difference between writing a check to the IRS every April and owing nothing. For the comfortable middle-class retiree, the math is equally real. A married couple bringing in $90,000 a year who has been paying federal income tax, the 22% bracket, gets $12,000 of new deductions. That is $2,640 back in their pocket. Every year for 4 years, until the deduction expires in 2028. That is the urgency. This deduction is not permanent. It exists for tax years 2025, 2026, 2027, and 2028. 4 years. After that, it expires, unless Congress extends it, which means every year you do not claim it is money you cannot recover. If you use tax software, it should apply it automatically. If someone prepares your return, ask them directly whether they applied the senior bonus deduction from the One Big Beautiful Bill Act. If they look confused, find someone who knows what that is. The deduction is real, it is available right now, and not claiming it is the most straightforward way to leave several $1,000s on the table this year. That is payment number 1. Payment number 2 is the low-income home energy assistance payment, and this one surprises people at both income levels for completely opposite reasons. Lower-income retirees are often surprised because they did not know the program existed or assumed they had to be in severe poverty to qualify. Comfortable middle-class retirees are surprised because they assumed their income was too high. Both groups leave money uncollected because of those assumptions. Here is the actual picture. The Low-Income Home Energy Assistance Program is a federal program that provides direct payments to help households cover heating and cooling costs. The payments go directly to your utility provider on your behalf, reducing your bill, or in some cases are paid directly to you as a reimbursement. The average benefit nationally is between $400 and over $1,000, depending on your state, your household size, and your energy costs. The income thresholds are higher than most people realize. The federal guidelines allow states to set eligibility at up to 60% of the state median income, and many states set their limits even higher using supplemental state funding. A single retiree in many states can qualify with income up to $24,000 or $25,000 a year. A married couple can qualify with combined income approaching $35,000 or $40,000 in some states. But here's the piece that almost everyone misses. Even if you are above the income threshold for the main benefit, most states have a separate emergency component and a crisis component for households facing utility shutoff or extraordinary energy costs. Those components have different and often higher income thresholds, and several states have separate senior-specific energy assistance programs with no income test at all for households where at least one person is 60 or older. The application is handled at the state level. You can find your state's program by going to the Department of Health and Human Services website or by calling 211, which is the National Social Services Referral Line. The call takes about 5 minutes. If you qualify, the payment can reduce your utility bill by several $100s per year with zero ongoing action required after the initial application. That is payment number 2. Payment number 3 is the one that makes retirees genuinely angry when they find out, and it is the Qualified Medicare Beneficiary Program. Let me be very specific here because this is where both income groups get told they do not qualify when very often they do. Medicare covers hospital care, doctor visits, and prescription drugs, but Medicare itself has costs. The standard Part B premium in 2026 is $185 a month. Part D drug coverage adds more, and for retirees who need supplemental Medigap coverage to cover what Medicare does not, the total monthly cost of health coverage can easily reach $500, $600, or more dollars per month. The Qualified Medicare Beneficiary Program, run by Medicaid but available to Medicare enrollees, pays those premiums for you. Not reduces them, pays them. Your Part B premium, your Part D premium, your deductibles, your coinsurance. The government pays all of it, and you pay zero. The income thresholds for full QMB benefits are modest. In 2026, a single person with income at or below approximately $1,260 a month qualifies. A married couple qualifies at approximately $1,700 a month combined. But above those limits, there are 3 additional levels of the Medicare Savings Program with progressively higher income thresholds, each of which covers a different portion of the Medicare costs. The specified low-income Medicare Beneficiary Program covers the Part B premium for individuals with income up to roughly $1,470 a month. The qualifying individual program extends that benefit further up the income scale. And here is the detail that catches almost everyone. Asset limits for the Medicare savings programs were eliminated at the federal level in 2023. The old rule said you could not have more than a certain amount in savings or investments to qualify. Those asset tests are gone, which means a retiree with modest income but a meaningful amount in savings may now qualify for premium assistance they were previously disqualified from. The income threshold is what matters. The savings balance no longer counts against you in most states. If you are paying Medicare premiums and your monthly income is below $2,000 as a single person or below $2,700 as a couple, call your state Medicaid office and ask specifically about the Medicare Savings Program and whether you qualify for any of the 4 levels. The call takes 15 minutes. If you qualify at even the lowest level, the government pays your Part B premium. At $185 a month, that is over $2,200 a year, every year. For a premium, you're currently paying out of your own pocket. That is payment number 3. Payment number 4 is the Extra Help program for prescription drug costs, and this one has a quirk that benefits the comfortable retiree almost more than the lower income one because of how the application interacts with other programs. Extra Help is a federal program run by the Social Security Administration that reduces or eliminates the costs of prescription drugs under Medicare Part D. There is no deductible. There is no coverage gap. The copayments are dramatically reduced. For a retiree who takes multiple prescription medications, Extra Help can reduce out-of-pocket drug costs by $1,500 to $4,000 a year or more. The income threshold for full Extra Help is approximately $22,000 a year for a single person and $29,000 for a married couple. Above those thresholds, there's a partial Extra Help benefit with higher income limits that provides meaningful but reduced assistance. But here's the part almost nobody explains. If you are enrolled in the Qualified Medicare Beneficiary Program I just described, you are automatically enrolled in Extra Help at the full benefit level. No separate application, no additional form. The enrollment happens automatically in the system, which means the single most powerful thing a lower income retiree can do is apply for the Medicare Savings Program, get approved at any level, and receive the automatic Extra Help enrollment that comes with it without filling out a single additional piece of paperwork. And for the comfortable retiree who is above the QMB income threshold, the Extra Help application is still worth completing independently. The income limits for partial Extra Help extend meaningfully above the QMB thresholds, and even partial assistance on prescription drug costs can save hundreds of dollars a year. The application is online at ssa.gov or by calling the Social Security Administration directly. It takes about 30 minutes to complete, and the eligibility determination is made within a few weeks. That is payment number 4. Payment number 5 is the one that is going to feel almost personal because it is the check you are missing for the work you did. Payment number 5 is the tax credit almost every low to moderate income retiree over 65 qualifies for, and almost none of them claim. It is called the credit for the elderly or the disabled, and it appears on Schedule R of your federal tax return. This is not a deduction. A deduction reduces your taxable income. This is a credit. A direct reduction of the actual tax you owe, dollar for dollar off your bill. Here is how it works. If you are 65 or older or permanently and totally disabled, and your income falls within certain limits, you can claim a credit of up to $7,500 against your federal tax liability. The income limits are modest. For a single filer, the credit phases out at income above $17,500. For a married couple filing jointly, it phases out at $25,000. Those numbers sound low, and for many retirees, their income may be above them. But here is what catches people. The income calculation for this credit excludes Social Security and certain disability payments from the income test, which means a retiree with Social Security income of $15,000 and a small pension of $4,000 may appear to have income of $19,000, but actually qualify for the credit based on the adjusted calculation that the IRS uses. The IRS itself publishes a worksheet. Inside Schedule R instructions that walks you through the exact calculation. Most tax software includes it. Most tax preparers skip it. I have reviewed returns prepared by national chain tax offices where this credit was sitting there unclaimed because the preparer did not check. On a return where it applied, the credit was worth between $200 and $750. Not life-changing for the comfortable retiree. For the retiree on a fixed income, $750 is a month of groceries. And the cruel irony is that the retirees who need it most are the ones most likely to be using free tax preparation services or basic software that does not flag it automatically. If you are 65 or older, your income is modest, and you have never seen Schedule R on your tax return, ask your preparer specifically whether you qualify for the credit for the elderly or the disabled. If they cannot answer clearly, that is a sign the return may not have been reviewed as carefully as it should have been. That is payment number 5. Now, I promised you 3 bonus moves, and I want to be clear about who these are specifically for. The 5 payments I just described reach across every income level in different ways. These last 3 are aimed at the retiree who has built up some assets, a home that has appreciated significantly, money in an investment account, a traditional IRA with a meaningful balance, If that is not your situation, the first 5 already have you covered. But if you have built something, these 3 can be worth more than everything else I described today combined. Bonus move number 1 is the tax-free home sale exclusion. And the reason I include it is that the fear of this tax is costing more retirees more quality of life than almost anything else I deal with. Here is the fear. You bought your home 20 or 30 years ago for $80,000 or $90,000. Today it is worth $400,000 or $500,000. And you are afraid that if you sell it, the IRS will take a large percentage of that gain. So you stay in a house that is too big, too expensive to maintain, and not where you want to be, because you are afraid of a tax that in many cases does not exist. The rule is called the home sale exclusion. If you have lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain from federal tax as a single filer. If you are married, the exclusion is $500,000. That is gain, not sale price. Gain is what you sold it for, minus what you paid, minus the cost of improvements you made over the years. A married couple who bought their home for $100,000 and sold it for $550,000 has a gain of $450,000. The exclusion covers $500,000. Their federal tax on that sale is 0. They were staying in a house they no longer wanted, afraid of a tax bill that was never going to come. The exclusion does not require you to buy another home. It does not require you to be a first-time mover. It does not have an age requirement. It requires 2 years of primary residence use within the last 5 years. That is the entire test. Bonus move number 2 is the 0% capital gains bracket, and this one is the best kept secret in the entire tax code for retirees who are in the low income years between retirement and when required minimum distributions begin. When your taxable income, after all deductions, falls below a certain threshold, your federal tax rate on long-term capital gains is 0%. In 2026, that threshold is approximately $48,000 for a single filer and $96,000 for a married couple. Taxable income after deductions. For a retiree in their late 60s drawing Social Security and a modest pension, whose total taxable income after the standard deduction and the senior bonus deduction falls below that line, any appreciated stocks, mutual funds, or other investments they sell in that year generate 0 federal capital gains tax. Not reduced. 0. The retiree who has an investment account with 30 years of gains sitting in it and sells those positions in a low-income year pays nothing on those gains. The same retiree who waits until required minimum distributions push their income above the threshold may pay 15% on the exact same gain. Same investment, same amount, different year, thousands of dollars of difference. The window between retirement and required minimum distributions is the opportunity. Use it deliberately. Look at your taxable income each year before December 31st and ask whether there are appreciated positions you should harvest while the rate is 0. Bonus. Move number 3 is for anyone who is 70 and a half or older, gives to charity, and has a traditional IRA. It is called the Qualified Charitable Distribution, and it is the most powerful tool in this entire video for the right person. Once you are 70 and a half, you can send money directly from your IRA to a qualifying charity, up to $111,000 per person in 2026. That money is completely excluded from your taxable income, not deducted from income, excluded from income entirely. It never enters the calculation. Most retirees who give to charity write a check from their bank account. They get no tax benefit because they take the standard deduction. The money they gave reduces their bank balance. Their taxable income stays the same. The qualified charitable distribution changes the entire equation. The money leaves the IRA and goes directly to the charity. It never touches your income. Your adjusted gross income is lower. Your Social Security taxation is lower. Your Medicare surcharge calculation is lower. Everything downstream of your income number improves. And if you have reached the age where required minimum distributions are mandatory, the qualified charitable distribution counts toward your requirement. Instead of taking forced taxable income, you redirect it to the cause you already support and pay 0 tax on it. If you give to your church, your hospital, your university, any qualifying charity, and you have money in a traditional IRA, and you have not been using the qualified charitable distribution, you are paying taxes you do not need to pay every year while giving the same amount of money. The only difference is where the check comes from. Let me tie all of this together with the one idea that matters more than any single program I described today. Every payment, every credit, every exemption, every exclusion on this list is real. The senior bonus deduction is in the law. The Energy Assistance Program is funded and waiting. The Medicare Savings Program is open for applications. The extra help enrollment is available. The tax credit is on your return. The home sale exclusion is in the code. The 0% bracket exists. The qualified charitable distribution is available at your IRA custodian today. Not a single one of them is automatic. The government does not mail you a check because you turned 65. The agency does not call when you qualify. The IRS does not apply the credit before you file. The energy program does not find you. You have to find it. Being legally entitled to a payment and actually receiving it are two completely different things. When the entire system is built so that the money stays where it is unless you stand up and claim it. I put together a free checklist, my 2026 Retirement Tax and Benefits Protection Checklist. It walks through every payment, every credit, every exemption on this list, including what form to use, what phone number to call, what deadline to watch, and which income level each program is designed for. So you can go through it one line at a time and make sure you're not leaving a single dollar on the table, whatever your income looks like. To get it, go to marcusgravestacks.com/checklist. The link is also in the description below this video. Print it out, keep it somewhere you will actually use it, and go through it before December 31st, because several of these programs have enrollment deadlines, and at least one of them expires in 2028 and will not come back. Let me leave you with this. The institutions that benefit from you not collecting these payments are counting on one thing. Not that you are careless, not that you are dishonest. They are counting on the fact that you assume these programs are for someone else. The struggling senior assumes the good programs are for people with more resources. The comfortable senior assumes the relief programs are for people with less. Both of them leave the same money on the same table for the same reason. Knowing a program exists and knowing it applies to you is the whole game. You now know 5 payments and 3 bonus moves. And you know that knowing is not enough. You have to claim them. Do one more thing. Send this video to one person in your life who is over 65. A parent, a neighbor, a friend, a sibling. It does not matter whether they are living on a single check or sitting on a paid-off house. The odds are very good that they are missing at least one of these payments right now, and one share from you today could be worth more to them than any gift you will ever give. That is what this channel is here to do. I will see you in the next one.